Hey,
We
look,
are.
if you're a Bitcoin bull, don't worry, be happy. Just things are chill, like
Oh, it's a
market
pretty chill.
opening nothing burger that, just calms the nerves. I thought that'd be a nice little song to play.
Everything except for the crypto boys.
Well, you know what? They didn't open up down too much. It's down a little bit over the weekend, but not sub 90, I guess.
Yeah, I know. We've seen some recanting. We've seen some recanting bulls over the weekend. I noticed a couple of notable ones move to the sidelines.
Who specifically? Actually,
I mean, listen. I mean, a couple of pretty vocal
you don't
sort
have
of
to call them
gold.
out.
Yeah, a couple of
That's fine.
notable gold and Bitcoin bulls that have dialed it back a little bit.
Well,
Listen,
it's interesting.
I'm not a grave dancer.
No, of course. That's why I said you don't have to call them out. But it just started around that time where we had October 9th, the 4% down day in NASDAQ, and then crypto literally had just an insane deleveraging that day. And I come back, and I think we've said it before, but I just come back to trading crypto in 2022 after Luna disappeared. That collateral's gone. They don't re-up you on your collateral, right? And so if you're massively leveraged, well, the asset reflects that. But the minute you lose that collateral that supports those asset prices, all of a sudden there's a different structure in place. And you get the initial short covering, but then you kind of are now in this weak period where you're searching for bids. And Rupert, you've been around longer than I have. Like, markets have this weird thing where on the way up, it doesn't need extra buyers. It's got enough, and people keep not wanting to put supply in the market. Whereas now, when the mentality changes, you need buyers to plug the hole so the ship doesn't, like Sailor's stupid tweet of the ship burning down.
That is a classic example of not using ChatGPT after a couple of scotches. I don't think he really thought through that prompt, or at least he clicked the wrong clicked the wrong selection when he chose the image.
I mean, it doesn't seem right. Like, here, check this out, right? So here, just real quick, I'll bring this to the forefront. Hang on, gotta add it to the stage. So the green line is the NASDAQ, and the white line is Bitcoin. And that was right around what I was talking about. You saw that high, then you saw this liquidation day right here, right? And then basically we're down 125 to 93, 94 where we're at now. So these two trade pretty in line if you look at this.
Okay. How easy is it to change that green line to ARK? Just do that.
To ARK?
Change the green to ARK, ARKK, yeah.
We could do that.
Yeah.
Do you want me to do 3 of them, or you want to just?
Well, I just think you're going to see a much closer correlation to that breakdown.
Okay. Green line is now ARK.
There you go. Yeah, it's almost perfect to the minute. There was a delayed function on the cues, right? I mean, listen, I don't trade crypto at all these days, but anecdotally, I'm hearing that liquidity is incredibly thin and has been for quite some time. Particularly since the disruption we saw a month and a bit ago.
Yeah, I think that you're just seeing liquidity. I'm going to take this off. Is that cool?
Yep.
Yeah. I think that you've seen liquidity decay in a lot of different areas for a month now. It started a little bit in September, but even in the credit stuff, we saw this BlackRock fund decide, hey, we're going to market at 100, and now Renovo has gone bankrupt. Now it's a 0. And so there's this lack of transparency that's going on. And I think there's a lot of people worried about what assets do I actually own with some of this stuff where something's marked it up. I mean, the 100 to 0 mark is this. It's like a real.
That's a new record, right? 0 to 0. That's a new record.
Yeah,
it's interesting. I mean, I've been doing some pretty nerdy work. I'm going to share a couple of slides here now. I've been doing some nerdy work on factors this weekend.
Well, you're kind of a nerd, so that makes sense.
Yeah, we try and do this thing together, right? So, what I was doing, can you see that?
You have to hit add to stage. I'll do it.
Yeah, add me to the stage.
Oh no, wrong one. Hang on, this one.
Okay, so what we've got here, we've got Kathy on top. Are we live now? Because I'm just looking at the chart.
Yeah, when is this since?
This is since Liberation Day lows, right?
Okay.
So you've got Kathy up top, right? You've got the Mag 7, the pink line. Then you've got S&P growth, S&P momentum, S&P quality factor, S&P value, then the equal weight, and the S&P dividend, and then you've got Warren Pye's quality plus trend systematic ETF as well. Now,
what's the green line on the bottom?
It's Warren Pye's ETF, FCT.
So he's on the bottom. Okay.
Yeah, which is again, it's an S&P 500 quality screen with a trend overlay. Now, the reason I was looking at this is because I own FCT as a part of a very small sort of broad-based US exposure within my beta portfolio. And it's been, listen, I own two of the worst. I own FCT and the equal weight RSP. Simply because I haven't wanted to chase the Mag 7. And what I thought was interesting was if you look at the same hang on. I have to stop sharing and reshare. Okay. I can't click through that thing as a. Okay.
Or we're just not tech savvy enough, basically.
There you go. Okay. Oh, fuck. Sorry, buddy. Can you see that one? Factors since Labor Day?
No, you have to add it, unfortunately.
Okay. Doing that now.
But while you're doing that, I mean, here you go. You got it.
There you go.
I'll let you keep going.
So since Labor Day, you've seen a sort of massive unwind. Now the point I was looking at these quality factors is that typically a lagging quality factor, right, has been indicative of trouble ahead in broader risk assets, right? We saw that in the late 90s ahead of the dot-com crash. We saw it in the mid 2000s ahead of the GFC, right? And, possibly lazily, what I've been doing is looking at the S&P factor indices or the ETFs that cover those factor indices and going, okay, I'm not reading much. They're pretty much birds of a feather with some variation, right? Until you realize that, and I'm going to show you this one, is that because of the outperformance of the Mag 7 over the last 15 years, guess what? The index compilers have started cooking the factor a little bit, and even in the value index, right? The top two holdings are Apple at 9 times next 12 months sales and Microsoft at 11.3 times next 12 months sales. So, and the quality factor is basically only 300 basis points off the S&P market cap weighted, right? So, these factor indices aren't giving it any kind of signal value that they would have done in the past, right? So I mean I mean I'm writing this up right now. It's going to go out in my start of the week note later today, and I just think that actually I was going, hey, this is really interesting, because I was wondering why, Warren's ETF was underperforming the quality factor ETF so dramatically. Well, one, he looks at a completely different measure. I mean, the old quality factor that the S&P uses is simply return on equity and leverage measures, right? It's a really simple screen. Whereas PIES goes into returns on invested capital, performance in downside vol moves, right? Sort of volatility on downside corrections, the outperformers in downside corrections. It's a much more sophisticated screen. And he's got a completely different set of names in there, and there's only one of the current Mag 7 in there, and that's Meta. Although I know you'd disagree with that as a quality stock right now.
No, I think that this is what I struggle with the whole concept of factors. It's like you're using words as some kind of vector to aggregate stocks, right? And the thing is, it's like a non-stable. You can be a compounder one day and a dog the next day. I mean, that time scale is a longer time scale, right? But like, look at Nike, long time compounder, now it's a dog, right? And I can name a lot of these. Value. What does value mean? What does quality mean? Like, I feel like there's a
that's what I see. I mean, these screens are incredibly simplistic, right? So value screens on a price to book multiple primarily, quality screens on a simplistic accounting return on equity, literally EPS over book value per share, right? With some sort of, leverage screener as well. High leverage equals bad. So, these are pretty simplistic measures, but I guess the reason that they're simplistic is so that the quants can go back over a long enough time frame to do the back tests, right? Because more sophisticated measures are difficult to measure over longer time periods in history, I guess.
Yeah, I mean, I get it. I always struggle with the idea of, like, when we say a word, you have an idea of what that word means. I have an idea of what that word means. Different ETFs, different shops are like, this is what it is, and everyone's got like a little bit different. So
it's like GARP. I mean, quality and GARP, it's the same thing, right? Who could ever argue with a wealth manager that put you in a quality index, right? Who could ever argue with a wealth manager that put you in growth at a reasonable price, right? And ultimately they become sort of marketing cherries, right, rather than anything else.
But like, let me show you this one here real quick. Like, this is the 1 month S&P implied and realized correlation versus the purple line is the high beta divided by the low volatility. And those are fairly easy, like, because we're not using words there. We're using, high beta. Is it the top decile? Is it the top 5%? Is it the top 20%? And then low volatility would be the same thing. And what you can see is, as implied, more importantly, realized correlation rises, you see underperformance of high beta versus low volatility. And I think of low volatility as kind of what you're thinking about as quality, like things that are stable, right? So, as you know, I've been long.
That's what. Sorry, that is what I would describe as high quality, but that is not what is given the traditional quality nomenclature by the index compilers, right? And I think that's my point here. Basically, all of those sort of classic headlines, like quality, value, or growth, have all been sort of gerrymandered, if you like, by the index compilers, as the Mang 7's been the only game in town for the last 10 to 15 years. And the compilers have just sort of sought every excuse to get as many of the 7 in there as they can. But, these high beta, low volatility type factor baskets that, Goldman punts around, are much truer to a maths definition. I think
this is the S&P's version of it, but like so of the S&P 500, right? So I'm trying to do apples to apples here, right?
Yeah.
S&P 1 month implied correlation, S&P 1 month realized correlation, which is just like, in essence, it's a way of seeing leverage, in my opinion. Like,
Yeah.
you see at the blue line is the Liberation Day, Monday. That was a massive deleveraging.
Yeah.
And then you see right before it, we had a lot of leverage. Right before we had this blow up, we're back at the 0 percentile for the implied correlation, right? So that's in essence like, hey, dispersion traders and a lot of various strategies who are, in essence, vol sellers or guys who are going long single stock vol and shorty index vol are basically tapped out. Like, they're max levered out. And when
Yeah.
you see these flat lines, and this basically does well. This isn't as long as I could show you, but like, it follows this. And so now we're seeing what's the interesting thing now is because the black line's implied, like, realize is just kind of picking up a little bit. Now we had that first move where we're talking about where the actual deleveraging like hit the market, like,
Mhm.
and then people said to start taking. This is when Bitcoin stopped trading well. This is when the beginning of the shit stocks or bubble stocks or whatever we want to call them, like, that was their peak. And then now we're starting to see this kind of gap means that the dealers are starting to back off. So there's a supply and demand issue going on there. And since then, right at that red line is where you've seen the high beta stocks starting to underperform what I would call quality. Again, I come back to the whole definitional thing, but like,
I
my
think we're
ex,
saying exactly the same. We're
yeah,
making exactly the same point about a definition, right? And lazy labels is what I'm saying.
yeah, like, totally agree. And all I'm saying is I've owned a big position in the XLP and the XLV and some other staples, and that's done quite well recently, especially on a relative basis. But XLV was up 9 days in a row, which was unbelievable. And that's guys getting out of some of this stuff and hedging, and in lower vol names. And I don't know.
Well, actually, and you know what? This switch is happening around the world as well. I was just sort of running through my book over the weekend. The low PE, high dividend stocks globally are crushing the higher beta names. This is not just a US phenomenon. If you look at my favorite cues of emerging markets, the EMQQ ETF. If you look at how that's performing relative to EM generally, it's had a week of chronic underperformance. So we are seeing this switch, globally right now.
And it makes sense because all it is just leverage, the leverage machine pulling back, or liquidity. When we talk about liquidity, we really mean leverage. People have they're plagued by this idea of money as a thing, right? Like, and I think it goes back to gold and money as a thing. But gold was never stable either, right? Like, over time, gold's purchasing power has been volatile. If you think about, like, go back to the Spanish price revolution in the 16th, 17th century when they brought all the gold and silver over from Latin America. And
Well, I mean, that was there was a change in base money from silver to gold, right? At that point, I mean,
agreed.
I
But I
keep
guess
on.
my point is there's no such thing as a stable unit of account ever. And I think that's what people like to think of. And then the other thing is that, like, in the way that today's monetary system globally works, so much of it is leverage. And they associate prices with money printing, but really it's leverage expansion, and that's a very different thing. The PPP loans and the stuff after COVID, that was a little bit of money printing there. Like, but what we've had since
There was proper
22.
helicopter money. Yeah, and there's proper helicopter money. Yes,
Yes.
I I completely agree
Yeah,
with that.
because remember, the commercial banks can create money. The central banks can't create money. Central banks can
Yeah.
create reserves. So they got the central banks to create loans that then were forgiven, and then the government issued money, and basically it was in essence a way of printing money, more or less. And then you see that in, like, the leverage come down quickly after that initial spike in 2020, debt to GDP is, and to be fair, the GDP was, that negative 33% Q2 2020 print might never be seen again. But anyway.
Well, interestingly, actually, when we started to cover this on Thursday, the other thing that has crept into the defensive bucket, right, is the energy names. And the energy names had a really strong week last week, and yeah, gas was strong, but oil was nothing special, right? And only at the front of the curve. I mean, I think, this sort of swing towards sort of lower duration exposures, I think has got some legs to it.
Why?
Well, because it's all the stocks that I like, Ben.
At least you're honest.
At least I'm being honest.
You are.
Listen, the market is a pendulum, right? We always just are constantly sort of batballing between duration factors generally, I think cometh the time, cometh the man, and we've now seen this trend over a few weeks now. I'm not quite sure what snaps a reversal, right? Now, the only thing that
here's the XLE divided by the SPY is just a very simplistic proxy. And if you go back to 2021, when we had basically another bubbly type period. 2020 is tough because of what happened with energy, but it started to pick up, chopped around. And so everyone will be like, oh, well, the war did this. And that's true. This spike was a lot to do with the war. But so we're seeing some relative strength.
Listen, it was moving way before the common knowledge became aware of Putin's aspirations for Ukraine, right? The energy stocks, the energy complex was moving aggressively in 21. And then, February 22 was the rocket fuel effect, and we got at the same time everyone reversing their love affair for Cathie Wood names, right?
Yeah, I mean, let's look at the oil services, the most hated kids in the block.
Yeah, I'll tell you what, if better than, are you using OIH there?
OIH, you want to use something different?
No, which one are you using? XES or?
I'm using OIH divided by SPY.
Yeah, do XES divided by SPY. The only thing is, something like, 45% of OIH is the big three, the Schlumbergers, the Halliburtons, Baker Hughes. I think it skews it a little bit.
It looks basically the same.
Yeah, okay.
But yeah, you're starting to see some pickup. And the thing that's interesting about this trade is, they've talked about this rumblings of Venezuela and Nigeria. Well, Venezuela is the largest oil reserve country in the world, even bigger than Saudi Arabia. And again, I'm not a guy who's on the ground, although I had this idea of getting involved in Venezuela 10 years ago, and somebody told me you need to have a gang. And I was like, I'm not very tough, and I don't have a gang, so I guess I'm going to pass on this idea. But the idea was,
I just talk tough.
On Twitter when I've had a few bourbons. But no, seriously, from what I understand is they're completely, depreciated, if you will. They've taken the copper and the metal, like all their infrastructure is not very good.
They've got to rebuild. They've got to rebuild the infrastructure to really start pumping. Is what I hear. So yes, I mean, good for services if that's going to happen, but gonna happen. But ultimately there are quite a few steps and quite a few perilous steps to get through before we see that supply come online.
But I hear you. But if you look at this chart relative to the S&P, it's damn near where it was in the 2020s, right?
Yeah.
So, and again, come back. I think we talked about this before, but I'll say it again. Is energy naturally not naturally, but in a low growth world, energy has a negative correlation with the S&P and the Qs and all these claims on money. So that, if you think about it, look at 2022. Even poor services was ripping higher, and the XLE was ripping higher, and oil was ripping higher, and I think it was the only sector in the S&P that was up for the year. I don't quote me on that. I'd have to look back, but I think
So
that
it
was
was,
right.
it was. I mean, that was certainly the case in the front half of the year. It then became a bit more troubled from the midpoint. Yeah, I mean, listen, I think this is where we sort of slightly go apart. I mean, your trigger was the low growth world. I'm seeing governments spend money all over the world right now, right? I'm seeing fiscal everywhere I turn right now. I wrote up a piece on Indonesia this weekend, right? Prabowo, the president there, is looking. I mean, Indonesia's been a real 5% GDP grower for about 10 to 15 years. Prabowo is coming in. He's having a last ditch to save the country from the middle income trap during his term and wants to boost it to 8%. He's instructing the banks to lend. He's jacking up investment in education and healthcare. This is an economy of almost 300 million people, and they're spending money, right? I'm not sure that we're necessarily going to have a shortage of growth around the world. But I know you're an avid deflationista at heart. So I mean,
well, even if you believe what you did, you can have it as a hedge. You're going to say, hey, look, if you need energy to grow. That's the bottom line. It's the governor that will shut it down no matter what. So central banks, commercial banks, whoever, if you put in fake money, fiat money growth, energy will eventually become the governor. Like, on a golf cart where they don't let you go faster than 25, energy is that little governor, basically. And so if we're underinvested in, CapEx, these guys should lead, wouldn't they? Kind of like a deep cyclical.
I think so. I think so.
Yeah, I mean, I look, again, it's been a long time since I've been pitched anybody, like even in 22 when they kind of worked. I think it just followed by nature, but I haven't heard anyone in a while get excited about energy services, is all I'm saying.
I've got a few readers that are long-term bag holders of the drill ships. Fortunately, I bought most of my exposure out of bankruptcy 5 years ago, right? So it's still money good, but it's been a hell of a round trip.
Yeah, and so ultimately, I guess the point is long energy the cash flows, at least in a lot of them, the MLP is some of the better E&Ps, and again, at least in the US, I'm much more versed and know CEOs and been in that game. It's such a better space than it was 10 years ago during, the last CapEx boom we saw in the United States, right? Like people have to remember the last CapEx boom we saw was the shale boom between 2010 and 2014, 15.
Those shale plays were the Cathie Woodstocks of 2004, 5, 6, right?
We were flipping MLPs and making 5 points in day one, and you were probably on the other side of some of those. It's probably the first time you ever heard of my firm. Well, this guy's participated in a lot of energy deals. It was hot back then.
Yeah, it's so funny. I mean, it's funny how these cycles turn. I think I've told the story before. In the middle of the sort of dot-com boom, our TMT investment banking team was literally 4 times the size of the rest of the investment banking department put together. And the industrials team was down to about 3 or 4 people. And you'd love this. They're always Midwesterners. The industrials team was always Midwesterners. So I think at least two of them from your home state in Wisconsin. And I remember them excitedly walking into my office, and this is timestamped. This was been about sort of late 99, and they said, "We've got an IPO." And I went, "Oh, really? Not from you guys. Not from you guys. We don't do IPOs for your team these days." He
You
said,
guys are on the
"No,
ban list.
no, we've got a B2B e-commerce platform for steel." It was, I kid you not, it was called iSteel Asia with 2 E's in the middle, right? But it was pretty good. The problem with that one is that it was actually making money, and we didn't do IPOs for companies that made money either.
Well, you gotta go with what the market wants. When the market wants speculative long duration, you feed them that. That's the one thing we can probably get close to calling it here. But the thing I've learned about shorting is that it's really good to sell what Wall Street's selling. Like, because ultimately in stocks, you need the supply. So MLPs, there was just new supply, new supply, every night I was getting, I don't know if you were
Yeah.
at Citi at the time, but like Citi every night there was like, oh, this deal and this deal. And then, junk bonds in the late 80s, emerging market debt in the 94, 95, and then .com, IPOs in the late 99, housing and credit stuff.
Yeah,
And
listen, I mean, I always used to get into trouble for this statement. I always used to see there are good deals and bad deals, and good deals get done, and bad deals get done. Don't get done, whoever's in charge, right? And there was always this sort of myth that, the right sales force could sell even a bad deal, which I think is absolute bullshit. You feed the market what the market wants, right? And they have they have the appetite, or if you like, they have the taste of a toddler in terms of what they want to eat. They only want to eat the same stuff at once.
And
And
it moves fast because we talked about CoreWeave in the beginning of the year, right? So post that Nvidia print where it kind of looked like they were stuffing the channel because they were switching between the old model and then the Blackwells, and you had some so people were a little nervous about the AI. They required Nvidia to come do 25% of the deal.
yeah, no,
And
but listen to this. Wait for this. I just saw this snippet from Herb's newsletter, right? CoreWeave insiders have wasted no time selling. They've now dumped 39.95 million shares worth more than $4.9 billion. That's 10.9% of shares outstanding and 14% of the public float. Yeah, and they only went public in January.
yeah, I mean,
I know if we didn't see that coming, well, we did see that coming. We talked about it at length in January. Anyway,
Yeah.
Benny, let's wrap it there. It's Sunday night. I'm really excited. I'm going to be recording from my hotel room for the Thursday night show in Perth, just before heading off to the Optus Stadium to see the first day of the first Ashes Test match, England-Australia. It's a big deal. It won't be for the Sunday night football fans, but I tell you, for cricket in cricket land, that's a big deal. So I'll be coming to you from Perth on my Friday morning, your Thursday evening.
All right, Thursday, 6 p.m. We'll be back at you, and
Are we
we're
doing
doing
6
the
or 7
Sunday
p.m.?
show.
Are we doing 6 or 7? Are we changing this to 7 p.m. now? What are we doing?
Well, it's up to you. I think 7 p.m. on Sundays for sure. It's up to you. You want to do on Thursday, 6 p.m. or 7. Either way.
Perfect. We'll tweet it out, guys. You'll hear. But see you on Thursday.
All right.
All right,
Later,
guys. Thanks, everybody. Cheers. Bye.